Welcome to the first edition of Inside the Portfolios with Hobart Wealth, part of the Hobart Wealth weekly series. I'm Jacob Woodrum, lead investment strategist, and today I really want to take you inside the portfolios, not just what we've done, but specifically how we think, because at the end of the day, our job is not just to allocate capital, it's really to make intentional decisions on your behalf. So before we get into the portfolios and discussing the markets, I want to share a quick story. This past weekend, I ran a half marathon. Now, this was the craft beer half marathon in Ballantyne, right near the office. I had two of my brothers come to town and we ran together. There was definitely some brotherly competition going on for any of you who have brothers, and I came out the victor. So I was really happy about that. But going into it, I had a plan. I had a pace that I wanted to stick to, and I was able to hit the time that I was shooting for, which I was really happy about, right about an hour and 35 minutes. I was aiming for that time. And, for most of the race, that plan felt good. But as I got towards the end, and especially the last few miles, and again, I know anybody who's a runner knows what this feeling is like, it got uncomfortable, really uncomfortable, frankly. And there's a moment in a race like that where your body is telling you slow down, or ease up. We've got to change the plan. But if you do that, you're not going to get the result that you train for. And I don't want to lose sight of that, because I think it's a really good reminder that short-term discomfort can't be the thing that ultimately changes a long-term plan, because the reality is the results that you want later are really built by the discipline that you stick to now. And that's exactly how we're thinking about markets today. Right now there's more uncertainty, but with that uncertainty comes opportunity. And I think the key with this is not avoiding volatility, but let's use it intentionally. So I want to take some time first, before we get specifically into portfolios, to just provide some perspective on market backdrop and really where we're at. Because when we take a step back, the backdrop is still constructive. Now, that may surprise some of you, but economic growth is holding up. Companies are still out there making lots of money. There are a few companies that are making a lot of money, and the earnings are still there for companies. Now, despite pressure from higher oil prices, and we'll talk a little bit about geopolitics in a bit, our current base case does remain positive on stocks on the year. So I think we're still going to have a positive year in the S&P 500, but what we really need to be talking about is specifically what has changed, and really how the market is rewarding investors moving forward, because it's really no longer rewarding broad exposure. Go buy the S&P 500 index fund, right, or a Vanguard index fund. It's really starting to reward precision and selectivity, and that's a key topic. So all that to say, we haven't pulled back. We've refined how we're taking risk. And what we're trying to do is really be more intentional, more balanced, and more selective in our exposures. And we'll talk a little bit about that specifically as we dig into the portfolios. Now, there's also a lot of focus right now on geopolitical events, especially in the Middle East, if you've been paying attention. And I've got a slide that I want to share here, because I think two slides specifically. One of these that I think is just really impactful is showing us from 1970 through current times, the growth of $10,000. So starting in 1970, if you put $10,000 to work in the S&P 500, you'd currently be sitting today with about over $3 million. Now that's a number. And, I think what's so interesting to me about this chart or this graph is that you can see all of the crises and events that have happened over this span of time. There's been a lot of stuff that's been going on, but this doesn't change, historically. I guess what I'll say is these events tend to create short-term volatility. And if we look at I'll show the next slide here as well. You can see that the events do create short-term volatility, right? We can see, Pearl Harbor attack, U.S. terrorist attacks, the Tet offensive, all of these things that occur, geopolitical events, they do cause short-term volatility, but they don't change the long-term direction. And so, we're not reacting emotionally to headlines. We're making disciplined decisions to the best of our ability based on what matters over time. So I just want to start with that. But let's transition now and go a little bit under the hood and look specifically and talk specifically about a couple of the portfolios and some of the changes and adjustments that we've made, allocations, why we've made them, and why they're working. But I do want to also mention, it'd be really easy for me to sit here and talk about this with you today and cherry pick some really good stuff, right? We're going to talk about some things that we've done that have been really impactful from a performance perspective in our portfolios. But, I'm going to be very real with you. And this is a time to also discuss stuff that's not working like we thought it would, and discuss why and how we're reacting to it and what we're doing about it. So let's start with aerospace and defense. I want to specifically focus on this. And these are all allocations that we've recently made, adjusted within our prime portfolios, really over the last 6 months, but more specifically over the last, really in the last quarter. So again, start with defense and aerospace. And what I'll mention up front is we initially added exposure here in September of 2025. Now that was before the current conflict began. And that's important because this wasn't a reaction on our part. It was a positioning. And when we look at global trends, defense spending tends to move in these long cycles, not short ones. And right now, what we're seeing is really a meaningful increase in global defense budgets. It's quite mind-blowing, but the U.S. alone is projecting roughly $1 trillion defense budget. And, that's part of a broader global shift towards defense and self-sufficiency. And so, when you hear that, we sit there and we say, okay, well, this creates what we believe is a demand cycle that I think will be multi-year for aerospace and defense companies. And we've got I want to share a slide here on that specifically that I think just speaks to a little bit of the historical, during previous cycles, the defense spending cycle, but the sector has actually really outperformed the broader market in this environment, even during periods of economic slowdown. But what we're looking at here is just a chart since 2024 election of the basically aerospace and defense industry's growth versus the S&P 500 in green. And you can see, roughly almost 80% growth in that industry and sector since the 2024 election versus about 22% in the S&P. And even if you just look at the 1 year, a pretty handedly outperforming dynamic going on here between S&P and this defense and aerospace exposure. So what did we do recently? We didn't chase headlines. We didn't panic. What we did is we really added selectively. So, the recent rebalance that we did, we've initially made it in September. We allocated towards this exposure. And then we actually increased the allocation just this past month in our rebalance. So, if the thesis is intact, we lean into it, not away from it. And that's really the takeaway specifically on that piece. Now, I want to talk next a little bit about this concept of reshoring. Some of you may have heard of this, some may not. But this allocation, we first actually invested in this in January of 2024. It's been a very strong performer for us in our portfolios. But I think what matters more than performance is really why we own it. And let me talk for a second first about this just reshoring trend, because it is a major trend that's happening right now. And really all that it is, it's kind of a technical term, but it's essentially just companies that are bringing back their manufacturing to the United States. Why would they do that? Well, there are many reasons, but, more control, quality control, offshore costs are increasing, and really just gives more ownership and flexibility in production. And so it's not a small trend. This is also a pretty amazing stat, but over 2 million jobs are tied to reshoring and this foreign direct investment. And that's what's been announced since 2010. So this opportunity, it doesn't appear to be going away. And I think it creates, further opportunity, not just in manufacturing, but in infrastructure and even regional banks that tend to support that activity. Now, things don't move in a straight line, right? And there are, economic growth could slow and we could see this be impacted in that way. But that's really the trend that we see and that we want to lean into. And so when this position performed well, like it has over the last couple of years, the question for us wasn't necessarily, do we take profits? But really the better question was, is this trend still intact? If the answer is yes, and for us the answer was yes, we think that it is, that's why that we actually added more to this exposure. So we're being mindful of allocations. We're not going to just load up in any one sector or industry, but we're being, to the best of our ability, smart about how we're investing in these types of sectors and industries. And I think the other key with this too, just to mention, is we're not trying to just find these opportunities, but from our investment committee standpoint, we want to continuously validate them to make sure that the reason to stay invested still makes sense. Now, I do want to shift just to a little bit to something that I think is just as important, but probably more often overlooked, and that's bonds. And I'll admit, so one of my colleagues, I'm not as much the bond guy as my colleague on the investment committee is, and I won't name names, but I let him be the bond guy, and he loves being the bond guy. But I do want to speak to this point just for a bit, because over the last few years, bonds really haven't always behaved the way investors have expected. If we think back to 2022, and that's where the dynamic of bonds as a kind of a risk mitigator didn't really pan out as the way you wanted it to. So they've acted kind of more like risk assets than stabilizers in the past. But that's changed, and so we made a change in how we have allocated and really where we've shifted towards. So one of the adjustments that we made, again, in our prime portfolios, was really to shift to high quality or higher quality government bonds, longer duration. Now, when I say longer duration, I'm sitting here talking about this and thinking about Chris tapping my shoulder and saying, "Hey, you're using technical language here. You need to calm down." Longer duration just means a longer time frame, right? So instead of a 5 or 10-year bond, maybe we're looking at a 15-year bond, right? So a little bit longer duration, and it does give us less exposure to credit risk. But the goal with this is pretty simple. When stocks are facing pressure, kind of like they are right now in the environment that we find ourselves in, we want this part of the portfolio and we need this part of the portfolio to do its job. So it's not about maximizing return with our bond exposure. It's more about building a portfolio that holds together across different environments. And that's really key. Now, I want to pivot here a little bit and talk about something that is just as important, because I mentioned we can, it's very easy for me to stand here and talk about, some of the things that have been really good in our portfolios. But I want to take the next few minutes to talk about two underperformers and really speak to that. So a position that hasn't performed as well recently in our prime portfolios is our cybersecurity exposure. And we initially invested in cybersecurity in early 2024 specifically, really because we believed, and frankly, we still believe, that AI and technology, as that expands, we feel that cybersecurity is going to become more and more critical, likely not less. And all that to say, though, recently the position has faced pressure. So right now it's down more than the S&P 500 over the last 6 months. And that's largely due to its exposure to software, because software in general, that industry has also faced headwinds. But if we zoom out, I think the key with this of zooming out, we're still positive since our initial investment. And more importantly, the thesis hasn't changed. So if anything, AI is increasing the need for cybersecurity, in our opinion. And really, we're seeing more advanced threats. You probably see it every day. I know I do. AI-driven phishing, and that's not phishing with a pole and a rod and a fishing lure. That's pH phishing. more sophisticated attacks, deep fake fraud. There's just a lot of that stuff out there right now. And at the same time, companies are investing quite a bit more heavily in defense. And I do want to I'm going to put up this slide here because this is easy, I think, to view visually, which is really just showing us the impact over the years and the proposed impact, expected impact of how much worldwide spending we're going to see in information security. And so it really speaks to the fact that it's going to become more important. I think cybersecurity moving forward becomes more and more important, not less important. And you can see the amount of spending that's expected moving forward. So, I think this becomes more of a process decision, not an emotional one. And the next slide that I want to share, again, on this cybersecurity trend, this just breaks down for us the return profile, different points in time. We can see the orange is showing us the drawdown over different periods of time in the cybersecurity sector and industry. And then specifically what the moving forward, what in the blue, what the 1 year total return has been after drawdown. So, we can see down 31%, down 32, down almost 34, but then we can see again the subsequent 1 year total return after drawdown. You can see right now, as of, middle of or end of February, the cybersecurity industry is down, right? And so we're experiencing that. But I think the question to ask here is it a broken investment, or is it just a temporarily pressured one? Right now, we believe that it's the latter. And I think this is also important. We don't expect every position to work all the time. We do expect every position, though, to have a clear reason behind it. And that's really the role of internally our investment committee and ensuring that we have process behind what we do within our portfolios. Now, I want to take a moment. I'm going to wrap up the portfolio section, but I want to take a moment first as well to walk through really what we're seeing in the Dynamic Growth Select portfolio, because there's been a meaningful disconnect between company performance and stock prices. The portfolio, it's faced a challenging start to the year, and we recognize that. But what's important is understanding what's actually happening beneath the surface. Because when we look at the underlying companies that we hold in that portfolio, specifically the top positions, we're seeing double-digit earnings growth. So earnings growth, that's exactly what we want to see, right? Double-digit earnings growth. And at the same time, we've seen share prices decline. And so you've got this dichotomy of, earnings going up, share price going down, and that kind of disconnect between growing earnings and falling prices, it's not typical. I will say over time, markets tend to correct that because ultimately share price follows earnings. And that's just how the markets work. But let me give you a real example because, right now, Microsoft is down roughly 30% from its highs. And this is from the highs back in October of last year. The business itself hasn't changed, right? They're still growing. They're still generating cash, still one of the most dominant platforms in the world. In fact, there are only a few companies in the S&P 500 generating over $100 billion in revenue annually. So that's sales, and still growing their sales at over 20%. It's pretty incredible. Microsoft is one. Again, you've heard of all these names. Amazon is another, and NVIDIA is the third. So these are not broken businesses. But what we're seeing here, and I think this is really key, specifically with a portfolio, it's not a crisis of earnings because the earnings are there, the money is being made. It's really a crisis of confidence. And those things are very different. Now, we also continue to believe in the long-term runway for cloud computing. I think, in our opinion, I think that's going to be driven by more traditional demand and really continued demand and expansion of AI. So yes, it's been a challenging stretch in this portfolio, but when we look at the fundamentals and the long-term opportunity, we see a path forward. And I think the takeaway with that is we also really remain confident in that as well. So when we step back and when we look at everything together, we're still constructive on the market, but we're being more selective in how we take risk. We're leaning into areas with long-term opportunity, and we're really trying to refine areas where risk needs to be better managed. So this is not about reacting to the headlines. It's about making intentional, disciplined decisions over time. Because we all know this, but markets will go through periods of discomfort. And I think the key, if we bring it back to the race that I had this weekend, it's just like that race, right? The question isn't whether it gets hard, because it was hard. It's whether we stay committed to the plan. And our job, when we think about what we do, our job is to make sure that your portfolio is built not just to endure that environment, but really to try to take advantage of it. So thank you for tuning in today. If you have any questions about your portfolio or anything that we covered today, please don't hesitate to reach out to our team. We're always here to help.